Continuing to move forward, we're going to talk about some other issues that arise with stock. Sometimes stock is issued with another security. This is called a lump sum. This can be warrants that are attached to it. It can be bonds with stocks attached. There's a bunch of different varieties that can happen in the real world. When more than one class of stock is issued for a single payment, this is a lump sum. These require that we allocate the proceeds between the two classes of the securities that are involved. There are two methods of allocations that are used. There's the proportional method and there's the incremental method. The proportional method is used when the fair value for each class of security is readily determinable. And the incremental method is used when the fair value of only one class of stock is known. Keep in mind that this could be where lump selling preferred with common stock, multiple different types of common stock, different types of preferred stock. There's not just the two. There's also subcategories within the broad variety of common. So to illustrate this, we're going to take a look at Beverage Corporation, who issued 300 shares of $10 value common stock and 100 shares of $50 par value preferred stock. One lump sum payment of $13,500. Now this can happen sometimes, especially when we are dealing with dealers and brokerages, selling a large quantity to a mutual fund, things of that nature. The common stock has a market value of $20 per share, and the preferred stock has a market value of $90 per share. Knowing what the market value is for both types of securities, we can use the proportional method. So we take the number of shares and multiply it by the market value of each share. To provide in the market, if we were to purchase 300 shares common, we would pay $6,000. In the market, if we were to purchase 100 shares of preferred value of preferred stock, we would pay $9,000. Therefore, the total market value associated with this transaction is actually $15,000. We then divide each share's market value by the total to ascertain what its percentage is of this entire transaction. We apply the appropriate percentages to the $13,500 to ascertain that common stock represents $5,400 of this lump sum payment, and preferred stock represents $8,100. Next, we'll prepare the journal entry to record the issuance of these shares. Now remember, these are par value shares. So let's look at how that works. We received $13,500 in cash. We have preferred stock, 100 shares, at a $50 par value. So $5,000 is credited to the preferred stock account. We are attributing $8,100 of the $13,500 transaction to preferred stock, so that leaves us with paid-in capital in excess of par preferred of $3,100. Our common stock had a $10 par value, so 300 shares, we will credit $3,000 to common stock, with $5,400 attributable to it from the transaction. That leaves us with $2,400 of paid-in capital in excess of par common. Now let's assume a slightly different situation where Beverage Corporation issued 300 shares of $10 par value common stock, 100 shares of $50 par value preferred stock for a lump sum value payment of $13,500. We know the common stock has a market value of $20 per share, but right now we don't have a market value for the preferred stock. It's unknown. What we do then is we take the 300 shares, the common stock, we multiply it by the $20 market value per share that we know. That's $6,000. We have definitive proof of $6,000 worth of fair market value. We reduce that from the $13,500, and that gives us a $7,500 difference that we would allocate to our preferred stock because it is the unknown factor. We take what we can prove, and the remainder goes to the unknown. So to prepare the journal entry to record the issuance of these shares, we still have $13,500. We have preferred stock, 100 shares at $50, or $5,000 that goes to our preferred stock capital account. This is the contributed capital. The excess, the $2,500, goes to our paid-in capital in excess of par preferred. We have $3,000, or 300 shares times $10 of par value for our common stock, and an additional $3,000 attributable to the $10 over par per share in market value to paid-in capital in excess of par. Another situation that can arise is when stock is issued in non-cash transactions. Now, there's a lot of reasons why stock can be issued for non-cash transactions. There could be a exchange of property or services. When that happens, there is a general rule. Companies should record stock that's issued for services or property, anything other than cash, at the fair value of the stock that's issued or the fair value of the non-cash consideration that's received. So the property or services, whichever is more clearly determinable. Well, let's look at an example of that. We have some series of transactions here that illustrate the procedure that record the issuance of 10,000 shares of $10 par value common stock for a patent for our Ganda company in a variety of circumstances. So in the first situation, our Ganda cannot readily determine the fair value of the patent, but it does know the fair value of the stock is $140,000. Therefore, we would record patents for $140,000, common stock for $100,000. 10,000 shares, $10 par value common stock. And then an additional $40,000 would be credited to the paid-in capital in excess of par common. In this situation, the fair value of the stock was the driver. What was the market value of the stock? Not the par value. What is the market value of the stock? In situation number 2, our Ganda cannot readily determine the value of the stock. This can happen at the beginning of a stock issue, or it can also happen if there's a class of stock that has not yet been issued that you are using in the transaction. But it is able to determine the fair value of the patent. The patent has a fair value of $150,000. So we would increase our intangible assets into the patents account by $150,000. We'd increase common stock by the $100,000. That's the par value of the shares of stock. And then the additional $50,000 we would credit to paid-in capital in excess of par, common. So here we're going with the determinable fair value of the patent. Now, sometimes in the beginning, especially if we're talking about something like a patent or and a new company or a new class of stock, it is very muddy and unclear what the value of either of them is as far as fair value. When that situation occurs, you go to an outside consultant. The outside consultant values the patent at $125,000 based on discounted expected cash flows. So that tells you discounted expected cash flows. He applied the time value of money to his consideration. This provides us a documentable amount to engage in this transaction. We increase patents by $125,000. The common stock increases by the par value of the shares issued, which is $100,000. And the additional $25,000 is credited to the paid-in capital in excess of par common stock. Some other issues that may happen with stock. When we are actually selling stock, we are going through a stock issue. It's not free. It's not like we can just say, okay, here you go, it's out there. There are some things that happen. There are underwriting costs that are associated with it. There's accounting and legal fees. When you're going public, there are a lot of things that are attributable to stock. There will be printing costs, taxes. Remember, we talked about some states that for no par stock levy very high taxes. These costs that are associated with the actual issuance of the stock should be reported as a reduction of the amounts paid in, typically to the paid-in capital in excess of par account. Throughout your text, you're going to find that there are these little small write-ups. This one regarding the disappearing receivable. I'll give you a second just to kind of look at it a little bit. As we encounter these, they bring to light some of the issues that have occurred and what happens with those issues. It will help develop your critical thinking skills, your professional judgment. So please do pay attention to these.